If you had to pick two assets to own for the next 10 years, just two, and you wanted to maximize the size of the opportunity in front of you, what would you pick? Not the safest assets, not the most popular, the ones with the largest gap between where they are today and where the math says they could go. That is the question I spent a long time answering, and the framework I use to answer it is called Total Addressable Market Analysis. TAM, Total Addressable Market, the theoretical ceiling on how large an opportunity can become. This video is about that framework, what it is, how I applied it, and why it led me to two specific concentrations I believe represent the largest investable opportunities available in public markets today. One of them I'm going to name directly, the other I'm going to describe by its thesis, and let the math speak for itself. Before I show you the assets, I need to show you the framework, because without it, the argument looks like speculation. With it, it looks like math. Total addressable market is the theoretical maximum value available to an asset or company if it captured its entire market. It is the ceiling. Here is why this matters. When you pick an asset, you are betting on a range of outcomes. If the TAM is small, even if you are completely right about the thesis, the upside is limited by the size of the market. You cannot grow beyond the ceiling. But when the TAM is enormous, when the opportunity being addressed is measured in the tens or hundreds of trillions of dollars, being early and even partially right is life-changing. The math on a small percentage of a very large number is extraordinary. This reframes the entire way you think about concentration. Most investors diversify to reduce risk. That is correct behavior for most assets. But when you find an asset at early stage positioning within a market so large that even partial penetration produces generational returns, diversifying away from it is not risk management. It is opportunity destruction. The gym taught me this lesson before I understood it in investing. High-intensity training is built on a counterintuitive premise. One all-out set taken to true failure produces more muscle stimulus than 5 moderate sets that stop short of it. The concentrated dose of intensity, applied to the right exercise, outperforms the spread of volume. Most people in the gym do the opposite. They spread effort across 15 exercises, never fully taxing any one movement, and wonder why they stop progressing after 6 months. They have diversified their stimulus so thoroughly that nothing is growing. The same principle applies to a portfolio. If you spread capital thinly across 30 positions, each receiving a modest allocation, you have created a situation where nothing can move the needle. You have bought the average without the conviction. Concentrated conviction in the right opportunity, where you have done the analysis and understand the thesis, is the investing equivalent of training to failure. It is uncomfortable. The feedback is delayed. And the results, over a long enough time horizon, are not comparable to the alternative. Asset 1, Bitcoin. Bitcoin is not a technology bet. It is a monetary market share argument. Every major global economy holds wealth in some form of reserve asset: gold, sovereign bonds, foreign currency reserves, real estate. The combined value of these stores of value is approximately $900 trillion. That is the market Bitcoin is competing to capture a share of. Gold alone has a market cap of approximately $16 trillion. Bitcoin at gold parity implies a price per coin that is a multiple of where it trades today. And gold parity is not the ceiling. It is one data point on the way to a larger argument. The argument for Bitcoin is not that it will go up. It is that it is the first asset in human history that is simultaneously scarce, portable, verifiable, programmable, and neutral. No government controls it. No central bank can debase it. It exists on a network that is run without interruption for over 15 years. Institutional adoption is in its early innings. Sovereign wealth funds are entering. Spot ETF approvals have opened the door to capital that was previously sitting on the sidelines, waiting for a compliant vehicle. I want to be honest about the risks, because credibility requires it. Bitcoin has experienced 50 to 80% drawdowns multiple times in its history. Cycle returns are structurally diminishing as market cap grows. A cycle that delivered 10 times in 2017 is unlikely to deliver 10 times again from a much larger base. And the timeline matters. A prolonged bear market in the first few years of a 10-year plan does real damage to the compounding math. The argument is not that Bitcoin will definitely deliver. It is that if you are going to take concentrated risk anywhere, this is the most defensible place to take it based on the size of the market being addressed. Asset 2. I'm not going to name this one by ticker. I'm going to describe it by thesis. There's a publicly traded company simultaneously addressing 4 distinct trillion-dollar markets. The first, autonomous transportation. The global automobile market is over $3 trillion annually. Full vehicle autonomy transforms the unit economics of that market entirely, from a product business to a service business operating at scale with dramatically lower marginal costs. The second, energy generation and storage. The transition away from fossil fuels is one of the largest capital reallocation events in modern history. This company produces both the generation and storage infrastructure required for that transition at a scale no pure-play energy company currently matches. The third, humanoid robotics. The global labor market is approximately $40 trillion annually. A humanoid robot capable of performing physical labor across manufacturing, logistics, and care settings addresses that market directly. This company is further along on this specific application than any public competitor. The fourth, AI compute infrastructure. This company has spent over a decade collecting real-world training data across millions of vehicles operating in uncontrolled environments. That data moat is not replicable. It is the foundation for an inference infrastructure that no competitor can build from scratch. The bear case on this company is almost always about one of these 4 markets, usually the first one. The bull case is about all 4 converging. The honest risks. This company trades at a valuation that demands execution proof. Timelines have slipped before. Regulatory risk is real. And the valuation captures much of the optimistic base case already, leaving limited margin for error. I want to spend a moment on the alternatives, because intellectual honesty requires addressing them. There are other assets with large TAMs. AI compute infrastructure is a genuinely massive market. Government and defense AI platforms address a $1 trillion opportunity. Nuclear energy infrastructure addresses decades of supply constraint in an AI-driven power demand surge. The distinction is stage of pricing. The assets I've described are compelling specifically because of where they sit between early stage and mature. The alternative large TAM assets I just named are real, but the market has already recognized them. You are buying less of a gap between current price and potential TAM capture. In public markets right now, nothing combines the TAM size, the early stage positioning, and the retail accessibility of Bitcoin and the Four-TAM convergence play at comparable asymmetry. That conclusion has been stress tested. The growth picks are difficult to displace. Here's the framework, simplified. Step 1. Identify the market being addressed. Not the product, not the company, the market. Step 2. Size the TAM honestly. What is the theoretical ceiling if this asset captures meaningful market share? Step 3. Assess current positioning. Is this early stage, where most of the upside still lies ahead, or late stage, where the market has already priced the opportunity? Step 4. Be honest about the risks. Timeline, drawdown tolerance, execution dependency. Step 5. Size the position based on conviction, not comfort. Concentration in a large TAM at early stage positioning is rational. Spreading that same capital across 30 positions because it feels safer is the decision that costs you the most over time. Concentrated risk in the largest addressable markets is different from concentrated risk for its own sake. This is not financial advice. These are documented positions built from real analysis, real conviction, and honest acknowledgement of the risks. Do your own research. Understand what you own before you buy it. The next video connects the growth engine back to the income floor, specifically the circuit breaker function and why the two engines have to run simultaneously for either one to work at its best. Subscribe if this is the kind of analysis you came here for. Drop a comment. What is your highest conviction TAM bet right now? And have you sized it accordingly? I read everyone. I'm built and bankrolled. Let's get to work.